I've been around long enough to see markets crash not once, not twice, but multiple times. And every single time people act shocked. They act like it came out of nowhere. But here's what they don't tell you. Market crashes are never surprises. Not if you know what to look for. I'm Robert Kiyosaki, and I've spent decades studying money, markets, and the patterns that separate the rich from everyone else. And today, I'm going to share something with you that could save your financial future. Because what I've learned is this: there are always warning signs before a crash. Always. The question is, are you paying attention? See, most people think market crashes are like lightning strikes, random, unpredictable. But that's what they want you to believe. The truth is, crashes follow patterns. The same patterns repeat over and over throughout history. And once you understand these patterns, you stop being a victim and start being prepared. You might even profit from them while everyone else is panicking. I remember 2008 like it was yesterday. People losing their homes, their retirement accounts cut in half, families destroyed. And you know what the worst part was? Most of them never saw it coming. They trusted the experts. They believed what they were told on the news. They thought their house was an asset when it was really a liability. But some of us saw it coming from miles away. We prepared. We positioned ourselves. And when everyone else was losing everything, we were buying assets for pennies on the dollar. That's not luck. That's financial education. That's understanding how the system really works. And that's exactly what I'm going to teach you today. Now, before we dive into the 4 patterns that always show up before a crash, let me tell you something important. The financial system is not designed for you to win. It's designed to transfer wealth from people who don't understand money to people who do. The banks, the government, the Federal Reserve, they're all playing a game. And if you don't know the rules, you're going to lose every single time. So let's go back in time, way back. Because these patterns, they didn't start with 2008 or even 1929. They go back centuries. And understanding this history is going to open your eyes to what's happening right now in today's market. The first market crash we have records of happened in 1634 in the Netherlands. That's almost 400 years ago. And you know what? Human psychology hasn't changed one bit since then. The same greed, the same fear, the same stupidity that caused that crash is still causing crashes today. So picture this, it's the 1600s. The Netherlands has just become independent. They've launched the East India Trading Company. They've invented the world's first stock market. They're dominating global trade just like America did after World War II. Money is flooding into the country. People are getting rich. And this is where the first pattern always appears. Pattern number 1, rampant speculation and investor overconfidence. Now, in the Netherlands during the 1630s, there was this flower called the tulip. Beautiful flower, rare, exotic. And wealthy people started buying them as status symbols. At first, 1 pound of tulips cost about a month's salary. That's like spending $3,300 on flowers today. Pretty crazy, right? But people did it because they wanted to show off. They wanted to impress their neighbors. Some things never change. But here's where it gets interesting. As more people wanted tulips, the price kept going up. And when prices go up, what happens? More people want in. They don't want to miss out. This is what I call the greater fool theory. You buy something not because it's actually valuable, but because you think some greater fool will pay you more for it tomorrow. The Dutch even invented futures contracts for tulips. You could lock in a price today for flowers you get next season. Sound familiar? That's because we still do this today with commodities, with stocks, with everything. But back then, it was brand new, and people didn't understand the risks. So imagine this. I buy a futures contract that says I can get tulips for $3,000. But by the time next season rolls around, tulips are selling for $30,000. My contract is suddenly worth a fortune. So what do people start doing? They start trading the contracts themselves. They're not even trading the actual flowers anymore. They're trading paper. Just like today with derivatives and all these complex financial instruments that most people don't understand. And this is investor overconfidence at its peak. People start thinking the price will keep going up forever, This is different. This time it's special. At the height of tulip mania, some bulbs were selling for 5 years of average salary. That's like paying $200,000 for a flower today, the kind of money you'd spend on a house, not a plant. Everyone thought they were geniuses. Everyone thought they'd found the secret to easy wealth. The shoemakers were giving investment tips. The farmers were getting rich. One little girl from Kansas, centuries later, we'd see the same pattern. She sent money to buy stock because everyone was doing it. But here's the truth I learned early in my investing career. When everyone thinks something can only go up, that's when you need to worry. When your barber starts giving you stock tips, when your taxi driver is talking about crypto, when everyone and their grandmother is investing in the same thing, that's not a sign to get in. That's a sign to get out. Because a crash always comes, always. In 1637, the tulip market collapsed. Overnight, prices dropped 90%, 95%. Some tulips became worthless. And it wasn't just the flowers. The futures market crashed. The land values crashed. Everything connected to tulips went down with the ship. People who thought they were wealthy woke up broke. Fortunes evaporated. And you know what people said? We didn't see it coming. This was unprecedented. Nobody could have predicted this. But that's a lie. The signs were always there. People just chose to ignore them because they were making money. Or at least they thought they were making money on paper. This brings us to pattern number 2, and this one is critical. Regulatory shortcomings. Now, let's jump forward to the 1920s, the roaring 20s. America is booming. World War I is over. The Industrial Revolution has created more wealth than any time in history. New technologies are everywhere. Cars, radios, electricity spreading across the country. People are getting rich. And just like in the Netherlands 300 years earlier, they think it'll last forever. This is the era of the Great Gatsby. Excess, parties, champagne. Everyone's making money in the stock market. And the government? They're not concerned. The economy looks great. Politicians are getting reelected. Why would they want to mess with a good thing? President Calvin Coolidge even said it himself. The chief business of the American people is business. In other words, leave the markets alone. Let them run wild. This was called the laissez-faire era. Minimal regulation, minimal oversight. Just let the good times roll. But here's what was really happening behind the scenes. Wall Street had invented something new called leverage investment trusts. These weren't your grandfather's mutual funds. These were funds that took investor money and then borrowed even more money on top of it to make bigger bets. Leverage, debt, and if things went well, the returns were massive. But if things went wrong, the losses would be catastrophic. And regular people, they didn't understand this. They just saw the returns. They saw people getting rich, so they invested their life savings. They borrowed money to invest. They put everything they had into these trusts because, hey, the stock market always goes up, right? This is exactly what I talk about in Rich Dad, Poor Dad. My poor dad, he believed in job security. He believed in saving money in the bank. He believed what he was told. My rich dad, he understood the game. He understood that the system is designed to make the banks and the insiders rich, not you. In the 1920s, these leveraged investment trusts started trading at double the value of the stocks they actually owned. Let me repeat that. The fund was worth twice as much as all the investments inside it. That's insane. That's like buying a basket of apples for $20 and then someone tells you the basket itself is worth $40. It doesn't make any sense. But when everyone's making money, nobody asks questions. Banks kept piling on more debt. They made bigger and riskier bets. And why not? The government wasn't going to stop them. Regulators weren't paying attention. Everyone was too busy counting their money. I learned this lesson the hard way in my own investing career. Back when I was starting out, I saw people making fortunes flipping houses with no money down. They'd borrow everything, buy a property, and flip it for a quick profit. And it worked. Until it didn't. When the market turned, all that leverage became an anchor dragging them underwater. The same thing happened in the 1920s. By October of 1929, the stock market had reached insane heights. And then it crashed. Not just a little dip. It dropped 89% over the next few years. 89%. That little girl who bought one share of Standard Oil, by the time she got her stock certificate, it was already down 15%. The next day, down another 10%. What followed was the Great Depression, 1 in 4. Americans unemployed. Families living in shanty towns. Soup lines stretching for blocks. It was the worst economic disaster in American history. And it all happened because regulators either acted too late or didn't act at all. See, there had been warning signs before. In 1907, there was another panic. Banks failed. The market crashed. And Theodore Roosevelt came in swinging, busting up the big trust, bringing in regulations. But he came in too hard, too fast, and that actually helped trigger the 1907 crash. So there's a balance. Too little regulation, and you get bubbles that pop catastrophically. Too much regulation too fast, and you can trigger a crash by shocking the system. Either way, regulatory shortcomings, whether from doing too little or doing too much at the wrong time, are always part of the pattern. After 1929, the government finally responded. They passed the Banking Act of 1933, also called Glass-Steagall. They separated commercial banks from investment banks. They created FDIC insurance so people couldn't lose their deposits if a bank failed. They learned their lesson, for a while anyway. But here's what I want you to understand. The government doesn't exist to protect you. It exists to protect the system. And the system is designed to transfer wealth from the poor and middle class to the rich. That's not a conspiracy theory. That's just how it works. The question is, which side are you going to be on? Now let's talk about pattern number 3. New, poorly understood innovations. Jump forward to the 1980s. This was the golden age of Wall Street. This is when bankers went from boring number crunchers in the back office to some of the richest people on earth. Gordon Gekko. Greed is good. You remember that era. And computers were changing everything. With computers, banks could create new financial products faster than ever before. Derivatives, options, futures, complicated instruments that promised to make everyone rich. And if your bank invented the next big thing, you could lock in massive profits. Your bonus would be huge. Even if it hurt the investors, even if it hurt the economy, you'd get paid. This is when portfolio insurance was invented. 2 professors, Black and Scholes, wrote a paper that inspired this idea. The concept was simple. Use computers to automatically trade stocks in a way that would limit your losses if the market dropped. It was supposed to be like a seatbelt for your investments. Sounds great, right? Protection from losses? Sign me up. But here's the problem. The system was complicated, really complicated. Even the banks selling it didn't fully understand how it worked. They just knew it was making them money. And investors, they loved it. By 1987, over $80 billion was being managed using these portfolio insurance models. But beneath all that confidence was a massive flaw that nobody saw coming. At the same time, Wall Street was going crazy with leveraged buyouts, hostile takeovers, Carl Icahn and corporate raiders making billions, flipping companies overnight.
Regular investors saw this and wanted in. They started buying stocks not based on the company's actual value, but hoping someone would come in and buy the company for a huge premium.
It was speculation on top of speculation. And at the peak, some guy from Cincinnati who worked for a tiny advisory firm announced he was buying a company for $6.8 billion. The stock shot up 7 times overnight. Except the guy wasn't actually buying anything. It was fake, a rumor. And the stock crashed back down as soon as people figured it out. But that showed you how frothy the market had become, how overconfident investors were, how desperate people were to believe the good times would last forever. Then in August of 1987, the market started to slide. Nothing dramatic at first, just a slow decline. But those portfolio insurance computers were watching, and they started doing exactly what they were programmed to do. They started selling stocks to limit losses. Except nobody realized that if everyone's computer starts selling at the same time, you don't get a gentle decline. You get an avalanche. The market started dropping faster, which triggered more selling, which made the market drop even faster, which triggered even more selling. It was a feedback loop, a death spiral. And on October 19th, 1987, Black Monday, the stock market crashed harder in one day than any day in history, harder than 1929, harder than 2008. The worst single-day drop ever. And you know what the brilliant minds on Wall Street said? We didn't see it coming. The models didn't predict this. This was unprecedented. But it wasn't unprecedented. It was the same pattern. Investor overconfidence, regulatory shortcomings, and a new innovation that nobody fully understood, creating risks that nobody had anticipated. This is why I don't trust complex financial products. When your banker can't explain how something works in simple terms, that's a red flag. When they use fancy language and mathematical models to justify something, watch out. The more complicated they make it sound, the more they're probably trying to hide something. I learned this from my rich dad. He always said, if you can't explain an investment to a 9-year-old, you don't understand it well enough to invest in it. That stayed with me my entire life. Now we come to pattern number 4, and this is the big one, the buildup of debt. Let's talk about 2008. This is the crash I knew was coming. I've been warning people for years. In fact, in 2002, I wrote in Rich Dad's Prophecy that we were heading for a massive crash. People thought I was crazy, but I wasn't crazy. I was just paying attention to the patterns. After the dot-com bubble burst in 2000, investors were scared of tech stocks. They wanted something safer, something stable. And what could be safer than real estate? Everyone needs a place to live, right? Housing prices always go up, right? Wrong. The banks responded by creating mortgage-backed securities and collateralized debt obligations, CDOs.
These were financial products so complex that even the people creating them didn't fully understand the risks.
But the idea was simple. Bundle up a bunch of mortgages, package them together, and sell them to investors as safe investments. And to make this work, banks needed more mortgages. So they started handing them out to anyone with a pulse. No income verification, no down payment, no problem. You want to buy a $500,000 house with no job and no money? Here's a loan. They called them ninja loans. No income, no job, no assets. And yes, that was a real thing. The banks didn't care if these people could actually pay back the loans because they weren't keeping the loans. They were packaging them up and selling them to investors. It was like a game of hot potato. Get the risk off your books as fast as possible and let someone else hold the bag. And regular people, they got caught up in it. They bought houses they couldn't afford. They took out adjustable rate mortgages with teaser rates that would explode after a few years. They treated their homes like ATMs, pulling out equity every time prices went up. They believed what everyone was telling them. Housing prices never go down. But I knew better because I understood the difference between assets and liabilities. Your house is not an asset. I don't care what your accountant tells you. An asset puts money in your pocket. A liability takes money out. And a house with a mortgage, that's taking money out every single month. That's a liability. Household debt grew rapidly in the years before 2008. People were buried in mortgages, car loans, credit card debt. And the Federal Reserve kept interest rates low, encouraging more borrowing. The government pushed home ownership, encouraging banks to lend to people who had no business buying a house. It was the perfect storm. All 4 patterns coming together at once. Clinton had pushed homeownership hard in the 90s and early 2000s. Bush kept rates low after 9/11 to stimulate the economy. Nobody wanted to stop the party. Not the government, not the banks, not the borrowers who thought they had found the secret to easy wealth. And those complex financial products, those CDOs and mortgage-backed securities, they were being rated AAA by credit agencies. The safest rating you can get, safer than U.S. Treasury bonds, they said. Except they were filled with garbage loans that were never going to be repaid. I saw it coming because I'd studied the patterns, I'd seen it before. And when you understand how the game is played, you can see the moves before they happen. In September of 2008, Lehman Brothers collapsed, one of the biggest investment banks in the world, gone overnight after over 150 years in business. The stock market crashed. Unemployment surged past 6% and kept climbing. People lost their jobs, they lost their homes, they lost their retirement savings. I remember driving through neighborhoods that used to be full of families, and they were just empty, foreclosure signs everywhere, entire subdivisions abandoned. It was devastating. And it was completely predictable. But here's what most people don't understand. That crash didn't happen overnight. It took years to build up. The debt piled up slowly. The bad loans accumulated. The warning signs were everywhere. People just chose to ignore them because they were making money, or they thought they were making money. This is the fourth pattern, the buildup of debt. When people, companies, or governments borrow too much money, eventually that debt has to be paid back. And if it can't be paid back, the whole system collapses. Right now in 2025, we're seeing the same patterns again. The national debt is over $30 trillion and climbing. Consumer debt is at all-time highs. Corporate debt is at all-time highs. The Fed has printed trillions of dollars in the last few years. And people think this can go on forever. It can't. So let me break down what you need to watch for. These four patterns are your early warning system. This is how you spot the next crash before it happens. Pattern one, investor overconfidence. Are people investing without thinking about actual value? Are they just buying because prices are going up? Are they using the greater fool theory, hoping to flip to someone else? When everyone around you is talking about how easy it is to make money, that's a warning sign. When people who have no business investing are pouring their life savings into speculative assets, watch out, right? Now, I see this in multiple places. I see it in meme stocks where people buy companies with no profits just because they saw it on social media. I see it in certain cryptocurrencies where people invest without understanding the technology or the risks. I see it in real estate markets where people are buying houses sight unseen, waiving inspections, paying way over asking price because they're afraid of missing out. This is the same psychology that drove tulip mania, the same psychology that drove the 1920s stock bubble. When everyone thinks they're a genius, the crash is coming. Pattern two, regulatory shortcomings. Are new markets popping up without proper oversight? Are regulators asleep at the wheel? Or are they about to swing in too hard and shock the system? Look at what's happening with cryptocurrency. For years, it operated in a gray area with minimal regulation. Now regulators are starting to crack down. But are they too late? Or will they overreach and trigger a crash? Look at what's happening with housing regulations, banking regulations, climate regulations. Change is coming, and change creates volatility. Pattern three, new, poorly understood innovations. Are people investing in things they don't understand? Are financial products getting more complex? Are people saying this time is different or we're in a new era? I see this today with artificial intelligence stocks. Don't get me wrong, AI is revolutionary. It's going to change the world. But when every company slaps AI on their name and their stock price doubles, that's not rational investing. That's speculation. I see it with special purpose acquisition companies, SPACs, these blank check companies that raise billions. I see it with complex derivatives and structured products that even the people selling them struggle to explain. When you hear phrases like algorithmic trading or decentralized finance or quantum computing investments, and the person explaining it can't tell you in simple terms what you're actually buying, that's a red flag. Pattern four, the buildup of debt. This is the big one. Are people borrowing too much? Are they buying things with money they don't have? Is the system leveraged to the max? Look at the numbers. U.S. national debt is over $34 trillion. That's more than $100,000 for every person in America. Corporate debt is at record levels. Consumer debt is at record levels. Student loan debt is at record levels. Auto loan debt is at record levels. Credit card debt is at record levels. And everyone just shrugs and says, well, that's just how it is now. Debt doesn't matter anymore. But debt always matters. Eventually, it has to be paid back. And when it can't be, the system breaks. I've built my entire investing philosophy around using debt intelligently. Good debt, debt that buys assets, that generate income, that's powerful. That's how the rich get richer. But bad debt, debt that buys liabilities, debt that you can't service, that's how people go broke. Right now, the amount of bad debt in the system is staggering. And when interest rates rise, which they have been, that debt becomes even more expensive to service. Companies that borrowed cheap money when rates were near zero are now struggling to refinance. People with adjustable rate mortgages are seeing their payments skyrocket. Credit card interest rates are crushing people. This is unsustainable. And when something is unsustainable, it will eventually stop. So what do you do? How do you protect yourself when you see these patterns forming? First, and this is critical, don't panic, sell everything, and move to cash. That's what broke people do. When the crash comes, cash loses value because the Federal Reserve will print more money to bail out the system. They always do. That means inflation. And inflation destroys cash. I learned this lesson from studying history. After every major crash, governments print money. After 1929, after 2008, after COVID in 2020, print, print, print. And when they print money, your cash is worth less. So what do you buy instead? Real assets, gold and silver. I've been talking about this for decades. Gold and silver are real money. They've been money for thousands of years. When currencies collapse, when markets crash, gold and silver hold their value, not because they're perfect investments, but because they're insurance. They protect your wealth when everything else is falling apart. But don't just buy gold and silver and sit on them. That's not enough. You need cash flowing assets.
Real estate that puts money in your pocket every month. Businesses that generate income. Stocks that pay dividends. Assets that produce cash flow are your defense against inflation and market crashes.
This is what I teach in the cash flow quadrant. Most people are stuck on the left side, trading time for money as employees or self-employed. But the rich are on the right side as business owners and investors. They own assets that generate passive income. And when the market crashes, that passive income keeps flowing. Second, don't try to time the market perfectly. Yes, I'm telling you the patterns to watch for. Yes, you can see when a crash is likely coming, but predicting the exact day or month, that's impossible. I knew 2008 was coming, but I thought it would hit in 2007. I was a year early. The key is to be positioned properly before the crash, not to try to jump in and out at the perfect time. Have your cash flowing assets in place. Have your gold and silver as insurance. Have your financial education solid so you understand what's happening. Then when the crash comes, you're ready to buy more assets at discount prices while everyone else is panicking. Third, increase your financial intelligence. Most people are financially illiterate. They don't understand the difference between assets and liabilities. They don't understand how debt works. They don't understand how taxes work. They don't understand how the monetary system works. This is by design. They don't teach financial education in schools because they don't want you to understand the game. They want you to be a good employee, pay your taxes, save money in a bank that pays you nothing while they lend it out at 5, 10, 15% interest. They want you to work until you're 65 and hope your 401k doesn't get wiped out in the next crash. But when you educate yourself, when you understand how money really works, everything changes. You stop being a victim and start being in control. You see opportunities where others see disasters. I've made more money buying assets during crashes than at any other time. 2008, I bought real estate at 50 cents on the dollar. Properties that were worth millions were selling for a fraction of that because everyone was panicking. But I knew the patterns. I knew the crash was temporary. I knew values would come back. And I had positioned myself with cash and credit lines so I could buy when everyone else was selling. That's the power of financial education. Fourth, focus on increasing your income, not cutting expenses. Most financial advisors tell you to save money, cut back, live below your means. That's broke person thinking. That's my poor dad's advice. My rich dad taught me different. He said, don't focus on cutting expenses. Focus on increasing your income. Because there's a limit to how much you can cut, but there's no limit to how much you can earn. So learn new skills. Start a side business. Invest in yourself. Create multiple streams of income. That way, when the crash comes and maybe you lose your job, you have other income sources to fall back on. You have the skills and knowledge to create wealth in any economy. And finally, understand that crashes are opportunities, not disasters. I know that sounds harsh when people are losing their homes and jobs, but that's the reality of the financial system. Wealth transfers from those who don't understand money to those who do. Every crash creates a new generation of wealthy people who bought assets at the bottom. The question is, are you going to be one of them? In 2008, while everyone was freaking out, I was shopping. I bought apartment buildings, I bought stocks, I bought gold and silver, and all of those investments have multiplied many times over since then. The same thing will happen in the next crash. And make no mistake, another crash is coming. Maybe this year, maybe next year, maybe 5 years from now. I don't know exactly when, but I know it's coming because the patterns are forming. The debt is unsustainable. The speculation is rampant. The regulations are either too loose or about to swing too hard. And people are investing in things they don't understand. All four patterns are present. The warning signs are flashing red. But unlike most people, you now know what to look for. You understand the patterns that repeat throughout history. You know that crashes don't come out of nowhere. They're predictable if you're paying attention. So here's what I want you to do. Take action. Don't just listen to this and go back to your normal life. Start building your financial intelligence. Start positioning yourself for the next crash. Get educated on assets and liabilities. Learn about real estate investing. Learn about precious metals. Learn about how the monetary system works. And most importantly, stop thinking like an employee and start thinking like an investor. Stop trading your time for money and start building assets that generate passive income. Stop worrying about job security and start building financial security that nobody can take away from you. Because when the next crash comes, and it will come, there'll be two types of people, those who are prepared and those who are not, those who understand the patterns and those who are blindsided, those who see opportunity and those who only see disaster. Which one are you going to be? I'm Robert Kiyosaki, and I've dedicated my life to teaching financial education because I believe everyone deserves the truth about money. The system is designed to keep you broke, but you don't have to play along. You can learn the rules. You can understand the patterns. You can position yourself to win. The next crash is coming. The patterns are clear. The debt is unsustainable. The speculation is rampant. The innovations are poorly understood. The regulations are inadequate. But now you know what to look for. Now you have the knowledge to protect yourself and even profit when others are losing everything. So take that knowledge and put it into action. Your financial future depends on it.